Is traditional life insurance still a thing? You may have heard that life insurance companies are hemorrhaging these days, and in this video, I'll explain why people are saying that and whether or not it's really true. All right, so number one, for the most part, no. Life insurance companies are doing just fine, despite what we might have heard on the dark web, and trust me, there's many conspiracies we know that have come true in the last couple of years. Yet no, people aren't dying in the masses. We're not seeing a massive difference right now. Therefore, insurance companies still are keeping their rates about the same. Insurance is not getting much more expensive. And yes, insurance companies are still very, very profitable. Just know that most insurance companies have number crunching nerds called actuaries that are crunching those numbers, or like little, I don't know, I look like a little rabbit or gerbil. I don't know what I'm doing here, but they're crunching their little numbers, trying to make it all work out. And then of course they say, hey, if you do this based on the statistics of how people are dying and who's dying and when and which ones you say yes to, which ones you say no to, because which ones you can deny and whatnot, they're doing just fine, right? This is not like health insurance companies where they can insure anybody they want. They can see somebody as high risk and say, nope, we're not going to insure you. So just know that life insurance companies are just as profitable as ever. Does that mean all of them will be that way? No, of course not. There are still risks that some insurance companies will take. Now, if you go back to the last recession, you remember AIG. Many people will say, well, I remember AIG, they were in trouble. Their insurance division wasn't in trouble. It's because they had investments in different types of stocks and different types of investment vehicles that actually made that part of their business go bankrupt, which affected their insurance business. But their insurance business was just fine. In fact, if you even go back to the Great Depression, did you know that while half of banks, your local bank that you go to, half of those banks went out of business, only about 4 insurance companies actually went out of business during the Great Depression. So even during the worst of times, insurance companies have actually been safer and more stable than even your traditional bank. Now, here's the key. What if they do happen to go out of business? What happens to your life insurance? Is it in trouble? The good news is this, is that every life insurance company is required to buy insurance for themselves, specifically what's called reinsurance. Now, reinsurance companies are global insurance companies that will insure the insurance company. So if they ever go out of business, the reinsurance company will step in and take care of all those insurance policies even after that insurance company went bankrupt. They'll take over those insurance policies, they'll protect them, they'll make sure the death benefit's there. If it has cash value, they'll protect the cash value until one of two things happen. Either one, those people die off and the policies are gone, or two, another insurance company steps in, buys those policies, and then keeps them in force just the way they were. So that's the beautiful thing, is that if you have a contract with those insurance companies right now, even if they go out of business, reinsurance companies can step in and take over and make sure that nothing changes, that you're doing just fine. Now, of course, we never want to be in the situation where a reinsurance company has to step in. So what are some key factors to look for in an insurance company? Number one, avoid stock companies. What do I mean by that? That means companies that are traded on the stock market. This would be like your MetLife, for example, right? Again, great company, but the companies that are traded on the stock market, when they receive profits, they pay to the shareholders, the stock shareholders. But if you use a mutual company, companies like Mass Mutual, Penn Mutual, anything with pretty much the word mutual in it, although some of them don't, like Guardian, for example, those mutual companies will actually pay their profits back to you as the policy owner. It's kind of like if you ever have a bank versus a credit union. You ever notice that credit unions will sometimes pay you a little bit more than the bank will? Well, that's because they say they don't have any shareholders, right? They say the member of that credit union, which is you, if you save your money there, the interest gets paid back to you. It's just like mutual companies. They're much like the credit union. When they pay their profits, they don't pay it to any real shareholders. They pay it back to those that actually have those life insurance policies. Specifically, if you have whole life insurance, they actually pay that back as part of their dividend, their return that they give back to you. So use mutual companies where the profits get paid back to you. Those tend to be safer. The second thing to look for is track record. When I look at an insurance company, and especially when we're looking to write those insurance policies, because we actually do write life insurance in our company as well, we look for a track record. We want to make sure that they've paid steady, stable dividends over time. Ideally, I like to have a company that's paid dividends for at least 100 years in a row. That means they've paid through all the recessions, multiple wars, including world wars, as well as the Depression. I want them to have that great track record. One of the companies we like to use has actually paid for 175 years straight, since 1847, which is when they started. I mean, imagine that. That was before the Civil War, and things were crazy during the Civil War financially too. So they've been paying for almost 200 years straight. Those are the kind of track records that we love because we know they've been through the worst of times as well as the best of times, and yet they still come out on top. They still are solid. Those are the kind of track records you like to look for. So ask your agent, if you're looking with an agent right now, ask them, how many years in a row have they paid dividends? And ideally, that number should be at least 100 years in a row. That's what I look for, at least. The third thing I look for also is called the comdex rating. And you can just do a simple Google search and look for this comdex rating. And the comdex has a score between 0 and 100. And really what it's looking at is the financial strength of that company. Now, I'm not saying that the top company is always the best for you to use. It just means that they're usually the most profitable, they have the most cash reserves, or maybe the largest company too. So we have companies like Mass Mutual, New York Life, even Northwestern Mutual that are very high on that score. Ideally, I like to see a comdex rating of at least mid-80s and above, right? If you start getting down in the 70s or even lower, it's kind of like grade school, right? You know, when you're looking at your grades, when you get to, not like today where my kids, they can still get a 60% and somehow pull off a C-. I don't know how that works. But what it really does is really looking at, are they a pass or fail grade? And in my opinion, if you're below an 80, that's pretty much like a fail grade. You don't want that kind of comdex rating. Ideally, you want at least 80s, if not into the 90s. You want solidarity. You want to make sure that they have a good track record and that they really, truly work for you. So again, to kind of recap those three things you want to look for. 1, use mutual companies. Don't use stock companies, right? Mutual companies tend to be more solid and they pay more dividends back to you as that owner. 2, look for a better track record, right? Look for that track record they've been paying dividends for at least 100 years. And then 3, look for that comdex rating, ideally in the 90s or at least mid to upper 80s. That comdex rating is everything, and you can just do a simple Google search and look that up for all of these companies. Now, let me give you a little bonus tip. Some people will say, okay, the company I'm with, maybe they go with Northwestern Mutual, maybe they go with a Mass Mutual or a Guardian or something like that, or New York Life. But then they say, but what if? What if, even though they might have paid for 100 years or more, what if something happens? What if the unthinkable happens? And even though we have reinsurance, what if that's not enough? Well, guys, one way you can do it is you can essentially diversify, right? We talk about diversification usually with risk. And again, this is very low risk. This is probably a lower risk you can do. This is almost like getting a bank type of savings. But just like with many people in banks, they say, well, what if there's that risk? Good point. Well, you can always have multiple insurance policies. So when you have multiple insurance policies, you may not just do it with one company, you might do it with different companies. Again, I still recommend they have a high comdex score, have a great track record of at least 100 years, but really look for those companies that have good track record, good scores, and of course, they're a mutual company. And of course, you can always reach out to us at moneyripples.com to find out how to do that if you want to see what's best out there right now to get your best returns. So that's the key thing, guys, is look for a great track record, look for mutual companies, great comdex rating, and of course, remember, reinsurance backs them up. Very, very rarely in history have life insurance companies failed, but if they do, that reinsurance will back them up. And of course, if you're worst case scenario, if you're really worried, just get multiple policies. All right, if you think this video is great, check out this video, How Do I Buy a Car with My Bank?